Hello, everyone, and welcome to our July investment market update. Today, I'm delighted to be joined again by Janet Mui, who's the head of market analysis for RBC Brewin Dolphin. Hi, Janet.
Hi, Mike. Thanks for having me.
Thanks for coming back again. You're becoming one of our regulars, so really appreciate you taking the time out. Obviously, we've seen you before on things like BBC News and Sky News and things like that, so really privileged to have you here today and get your thoughts on what I think has been a really interesting few months out there in the markets. Hopefully, you'll be able to give us a bit more information on that and give us your views on where we've been and where you think we're going.
Indeed. Thanks, Mike. So I think I'll begin with talking about some major market development and our macro views. I think this year the market has been doing great. I think it's a bull market. We are observing new highs for major indices around the world. Actually, we saw that in the UK, we saw that in US, we saw that in Japan. So I think the market really appreciates the current macroeconomic backdrop, which is what we call a Goldilocks backdrop, which is data is not too hot, not too cold. And I think primarily this is, again, a very US-based story. Everyone is watching the US labor market. And if you remember, right, the key concern for markets over the past 2 years has been inflation. And primarily that was energy prices, that were food prices. And then the last bit of that is really from the labor market. But now we are really starting to see evidence that the labor market is cooling down, but cooling down to the extent that it is not falling off a cliff. You know, it is actually a very difficult balance to achieve, right? But it really seems that magically we are heading in that direction. If you look at this chart, which shows the number of job openings per number of unemployed in the US, which is a metric that a lot of people have been following very closely because it just tells you how tight the job market is. We are right at where the pandemic began. So we are basically back, going from a very hot US job market to now just, normalized back to where we were. So that's actually great news, right? So this particular backdrop really supports the idea that inflation is going to go back to 2%. And in fact, we did see inflation slowing down notably. As I mentioned, a lot of that slowdown has been due to energy prices, food prices, goods prices. The last bit of the puzzle is really the labor market, right? And now we are getting more evidence that, the labor market is cooling down. So
Janet, how does the labor market intrinsically link to inflation? So if we're seeing the numbers come down on the labor market, that means there's less jobs created out there for people to possibly go into. Is that keeping wages down? Is that having an impact? Is that how it's interlinked?
Yeah, that is supposed to be the mechanism. So if you're a business and you cannot find the workers, you have to pay higher wages to attract the right workers, right? And you ultimately will have to pass on that cost, right? That's the theoretical idea. And if there's ongoing wage growth, people can spend more, and then that just lead to more demand and more price pressures, for example. So this is theoretically how it works. So when you see a more balanced labor market whereby the wage growth is slowing down, we're talking about, at one point wage growth were growing at 6-7% in the US, and now it's down to 4%. So that's quite a big change. And I think that's primarily the driver for the services inflation that we're seeing around the world. And to continue, if you look at this chart, the CPI, the Consumer Price Index inflation, wow, all heading into the right direction. Great progress. So this is the thing that, one of the key reasons why the markets have been up so much, right? One of the biggest concerns you have, suddenly you don't need to lose your sleep at night anymore worrying about how volatile that inflation will go, right? That's the big difference we are seeing at the moment. In particular, UK inflation is actually down to 2%, which is quite good. But, the thing about the UK inflation, it is quite complicated. While I said US, say the wage inflation, the services inflation is coming down nicely, UK wage growth and services inflation is still 5.7%. That's completely incompatible with the 2% inflation target. And this chart shows clearly what I mentioned about, this inflation is really caused by lower goods price. I think a lot of that is down to China, right? China is having a deflation in terms of its manufacturing sector, and the currency has been very weak, so it just exports lower inflation across the world by goods. I mean, we all know how much we depend on China in terms of goods, right? I think most of the stuff you have from Amazon is made in China. So I think that is helpful. But at the same time, you see that the services inflation and the wage inflation is still elevated. So that is the thing that complicates how much the Bank of England can really cut interest rates going forward. So if you look at so maybe I'll skip over this chart. If you look at where market is pricing in for rate cuts at the moment, you can see that the UK probably the last central bank to cut, and maybe the eventual level of interest rates could be the highest amongst the major economies. But all that can change, obviously, right? Depending on the incoming data. So right now, the thing that really excites market is that the US Fed cut is probably coming as soon as September, right? So finally, there has been so much chatter about when they're going to cut all over the year. And finally, we're getting really, really close to that point, right? As I mentioned, the data is supported, particularly the weakening of the labor market and where inflation is headed, right? For the UK, as I mentioned, is a little bit complex. I think previously a lot of hope on an August rate cut. I mean, it's still on the table potentially, but I think the probability is lower now. So it's just get pushed back further and further. Again, that really depends on the data. I can't confidently predict when exactly that rate cut is going to happen. But I think the situation is likely to be a bit more complex in the UK. Whereas the European Central Bank, they already cut once. I think they're sounding a little bit more cautious, not to pre-commit to a particular date, but they equally didn't push back against the idea of 2 rate cuts later this year. So I think the broad picture is that rate cuts are coming, but it is probably going to be a kind of a shallow rate cut cycle, as you can see from this chart, which shows the market pricing for rate path going into the end of 2025. So pretty shallow, but you still get the rate cuts. Ultimately, it's still going to be an easing in the financial conditions.
That's really intriguing, though, to see that historically the US has always been the first major economy to cut rates. And there was, I think it hasn't really proven to be problematic, but there was a lot of publicity about the fact that the Eurozone went first. Do you have a view on that? Or do you think it's just because that's history and therefore it felt like it was a no-no, but actually in reality it doesn't make a difference. It's different economic circumstances and it's quite a bold move by the Eurozone.
Oh, that's absolutely what you described just now. I think in a way it's encouraging that the central bank is really prioritizing what's happening domestically and acts accordingly. And it's just really based on this mantra of data dependency. So I'm glad they actually stick to that. It makes them actually more credible instead of sticking to a story of, well, we have to wait for the Fed to cut, right? I think actually that's encouraging. And I think, there has been pressure for the Bank of England to cut. But again, they're really looking at domestic set of data and judge, maybe we're not there yet. So I think it's actually a good development. It just makes the whole system more credible to markets, which I think is important.
Couldn't agree more. I mean, another part of the business we have is obviously dealing with mortgages. And excuse me, what I guess we've really started to see is that it's this year more than the last few years where those interest rate rises have started to really bite. People coming out of their fixed rate mortgages and seeing anywhere from a couple of £100 up to even £800-900 a month more on their monthly interest payments on their mortgage. So any surplus cash that people did have to spend seems to have been completely absorbed now by those future mortgage rates. And I guess the other point there is that people are now fixing in at these higher rates for 2, 3, 4, 5 years because they need that certainty over those costs. But that then means that money is baked in, isn't it? That loss of disposable income is baked in. And I guess that's why there is a feeling now that inflation may stay a bit lower. I appreciate you obviously said that the differences within the UK market, but if people have less disposable income and inflation is lower, then there is no sort of pressure for wage growth, then I guess that means that there should be more consistency in the inflation figures and interest rates over the coming years. Is that a fair assumption, or is it not quite?
I think that's a fair assumption. I think, as I mentioned, over the course of the past year or so, we did see the labor market slowing down. So I think that's really the driver of where the Bank of England may cut interest rates, because ultimately it takes time for that interest rate increases to show through in the economy. And as you said, it is already showing, and it will increasingly show. So I think that's why they're leaning on rate cuts. There's no doubt about it, right? Markets are not stupid. That's why they're pricing in a couple of rate cuts till the end of 2025, right? So it is sort of certain in a way we're getting the rate cuts, but it's just uncertain when they're going to start it. I think in a way they have to act in a responsible way. If the data currently is so far away from the reality of the justification to cut rate, it is just difficult. I mean, as I said, services inflation 5.7, wage growth 5.7. It's just very hard to articulate well why you may cut, as well as the fact that the latest GDP figure was very strong. It was double what was expected. So it does suggest we came from a recession environment last year to now a pretty strong recovery in the first half of the year. So I think they have this reservation.
And that's in spite of the interest rates, isn't it? So if interest rates aren't having that dampening effect and actually growth is still progressing, then, like you said, there is no real pressure to be dropping rates to try and get the economy going, because actually the economy is moving as under current conditions. That obviously can change, and I guess they're always going to keep an eye on that to see, do we need to make that change to try and help the economy along? But right now, if the economy is doing well, that there's no pressure, is there, to sort of drop the rates anytime soon?
Exactly. I think there are many moving parts to drive economies and inflation. So you mentioned about the mortgage rates. They're absolutely well aware that more people are remortgaging into higher rates over the next few years. So they know that the pressure on households is increasing. But at the same time, there are other factors that are supportive to the economy. For example, inflation is slowing down, so real wage growth is actually rising.
Yeah.
There are various factors that are supportive or a drag to the economy. It's very hard to know exactly when that pivot point will be. So I think the best that they can do is to be data dependent and to have a sense of caution as well.
Brilliant.
Yeah, so I can continue. So, so I think one notable development actually is that sterling has really strengthened, one of the best currencies amongst the major currency group, and actually it was trading 130 to the dollar recently. And I think there are several factors that support that. First of all, I think after the election, right, we have this landslide majority for Labour government. And I think this is a trigger point for investors that we are having a new start. And this could be a good for stability for the UK, because if you compare to the political chaos in France and what's currently happened in the US, suddenly the UK relatively looks better in terms of the political situation, because they have such a big majority, they can get past the policy and reforms and changes. So I think there's a distinct change in the investor sentiment, which boosted sterling. And you also throw in the data, the better than expected GDP data, that's very helpful. And I think the IMF, the International Monetary Fund, recently upgraded UK GDP growth as well. So all of a sudden, it seems that there's a lot of luck going on ever since the election, which I find is pretty amazing. So I think it's good. It's a good thing for the economy. We have good, higher sterling, and more stability perceived in the UK market. So I think that's one of the key development. I think that's positive for our
Absolutely
clients.
incredible, really. And I think you've hit the nail on the head that it's almost the fact that because there is such a majority, that there is a direction of travel. And I talk to clients about the fact that markets like an understanding of just consistency in approach. They want to know what they're getting, and therefore actually having a majority, regardless of whatever the political outlook might be, is almost, that doesn't matter so much. It's about that consistency. It's the approach. It's knowing that the majority is there and that legislation will go through and certain things will stick. And also, as you said, because there's a lot of political discord across the rest of Europe and other places, funnily enough, that element of stability in the UK, all of a sudden puts us in a really positive light. Whereas actually the last 5-6 years, we've because of Brexit, because of COVID, because of everything else that's gone on, we've really been nowhere to be seen. We've been languishing with really low rates and values on sterling. So quite a marked tick up there on both the euro and the dollar.
Yes, I think it's very important to highlight how investment sentiment is so important, because I think ever since Brexit, a lot of institutions were underweight UK. It was one of the most hated region. I think gradually that view has slightly improved, but not much. And then suddenly, I think we're at the point where a lot of institutions are starting to get incrementally more positive, and some institutions, some really big banks, outright upgraded UK, putting them from neutral to overweight. So I think if we continue to see that, there would be quite significant inflows in the UK market, which I think it will be further reinforcing that positivity. So yeah, looking great.
Brilliant.
Yeah, so in terms of investment views, right, we are still positive on equities. I think here I lay out why we are overweight in equities, why we continue to think equities will do well relative to other assets, but also we are not going more overweight. So we'll explain why. So the key reason why overweight equities is the macroeconomic situation is good. As I said, this is a Goldilocks macro backdrop. You can see the chart there. It basically shows US GDP and CPI forecast. I mean, obviously forecast is not entirely the reality, but it gives you a good idea of where things are heading. And you can see that CPI is slowing toward 2%, whereas growth is slowing, but is not falling off a cliff. It's not negative. So we're not likely to see a recession. And this is actually the kind of environment that is good for market. Sometimes you don't need growth to be very, very strong. If you have growth that is too strong, then you have inflation concerns. Then interest rates stay high, right? We're in an environment where growth is okay, slowing down, but you then get the rate cuts, right? So this is actually a good environment. And of course, which we'll discuss later, is really the artificial intelligence theme, which recently there is a bit of a wobble, but long-term trajectory is intact. We'll discuss a bit more on that. But the thing is, we're not more positive in equities. The reason why is ultimately, I think in terms of the economic cycle, we are quite late stage already. Obviously, this late stage can continue for as long as it can. The last economic expansion cycle, right? It was 10 years. So, is late stage, it may not be the most exciting stage. The reason why I'm saying is that when you have the recovery and the expansion phase, your GDP growth just rise, right? But now we're in a situation where GDP is actually slowing down in the US. So it's just worth exercising a little bit more caution at this stage of the cycle. And also US equity valuation is arguably elevated. We'll talk a bit more about that, and that's why we actually start to favor the UK, which valuation is half of what the US currently is. And of course, as we know, in the past couple of days, there is a lot of chatter on trade tension because the probability of Donald Trump being re-elected has risen a lot ever since his assassination attempt. So these are the risks that we have to balance, and we don't want to be too extremely bullish at this stage. So going into the next slide, so our core view is that US equities is likely to outperform, and the view is based on the fact that the US equity index, just by default, has some of the best run companies in the world, right? Really high quality, strong balance sheet, really strong profit, and the growth is it will compound into the future, which we think is a very desirable feature that you may not easily find in other regions. And particularly, we all know about the Magnificent Seven, right? These are stocks that have such giant moat, and they have such large networking effects and strong balance sheet and high quality business that is very hard to replace. These, I think we're still quite comfortable in the fact that these mega cap stocks are driving the market rally. So yeah, we're still comfortable with that idea. But obviously, recently, there has been a rotation out from these large cap to smaller caps, which actually fundamentally is a good thing, right? So first of all, the first point is that people have been worried so much about the concentration in the rally. So if the rally is broadening out, that is great. And that is fundamentally supported by the rate cut argument. So that's the first point. Secondly, I mean, I understand there is a worry that there will be outflows from these mega caps to these smaller caps. But, it's not a zero-sum game, right? The fact is both can do well at the same time. If the expectation is that actually this is going to be a more sustainable and persistent rally, right? So I don't think the rally in small cap has to be totally at the expense of the large cap, right? So I think that's a very important point to pick out. So again, I think what happened in the recent week suggests to us that diversification is very important. We like these large cap stocks, we like the US, but at the same time, nobody can predict when some of these rotation may happen. So as always, diversification is absolutely important, right? So when we think about the risk out there, so what I said is a pretty Goldilocks environment is a positive backdrop, basically. But again, we can't foresee the future, and you cannot deny that the geopolitical uncertainty right now is actually quite high, right? If you look at this chart there, it shows the geopolitical uncertainty index, and I think we are at the period where the risk is actually higher than in the previous decade, basically. I think needless to say, is because we have 2 wars going on, right? And we have a lot of elections this year and proving to be quite consequential. And of course, the US election that is going to be in November. So I think we have to think about portfolio in terms of thinking how to mitigate those risks, right? So for us, I think key risk would be inflation, because inflation has come down, yes, but if Donald Trump were to be president, for example, then I think a pretty consensus view is that it could be inflationary because he wants to extend the tax cut and he wants to raise tariffs. He wants to, the budget deficit may increase. So that is perhaps a most likely scenario, inflationary. So you want to think about inflation hedges. And to us, right, energy stocks, it could be a good hedge. And within that, UK equities, as we all know, have good exposure to energy stocks. So, and it is a cheap way, right? As I said, the valuation of UK equities, half of that in the US. And to us, geopolitical uncertainty is actually very difficult to position for. And historically, gold tends to be a good hedge against all these. So in total, we like UK equities, energy majors, gold, and also some government bonds in order to hedge against all these macro risk. So I think from our perspective, a balanced approach is a good idea. We like the US, we like the growth areas. You really want to get exposure to that AI theme because that's secular. That's growing very strongly. You don't want to miss out that. But having said that, of course, there's risk involved. And to hedge that risk, we think it makes sense to have UK equities, to have energy stocks, to have bond, and to have gold in your portfolio. So that's pretty much what we're currently thinking at the moment, given the the global macroeconomic backdrop.
Do you think, Janet, that the Fed's decisions around dropping interest rates, I know they're not meant to be political, but obviously they need to consider the political landscape as to the impact it might have on the economy and therefore their rate cuts. Are they holding off perhaps as there seems to be more chance of Donald Trump getting into office based on what you've just mentioned about inflation? Do you think they might be holding off to see if they've got a little bit more ability to influence inflation over the coming months if he is successful?
Yeah, I think that's a debate for the market at the moment. So what you say is that in the near term, there's this slowing inflation that would support the Fed to cut. But over the medium term, there's this inflationary pressure that maybe Donald Trump as a president will impose. It is difficult, but I think the Fed will prioritize the near-term outlook first, because as I said, in the medium term, his policy, his trade protectionism, it could be inflationary, but there's a lot of uncertainty surrounding that assessment. The reason why I say that is because if we do have trade tariff, we have this trade war going on, maybe consumers will suffer. They pay more for the goods and they spend less on services, and that could hurt jobs, etc. So we don't know yet. So I think the Fed will prioritize what is happening in the near future first. Okay. And it's honestly, they have well telegraphed that they are going to they lean on cutting rates, and they can always be cautious, right? They're not going to cut in a very steep manner. They're just going to be, one cut maybe per quarter and then see how it goes. So they can always give them some room to maneuver, I think.
That's great. Thank you.
Yeah, I think that's really it from my part.
Superb. Well, look, Janet, really appreciate it. I think that's a great oversight as to what's gone on, where we stand today, what's going on with interest rates, and really what might or might not happen depending on whoever's successful in the US. So thank you ever so much for your time again and joining us. And I hope you get some sunshine at some point over the summer.
I'll help all of us do. Thank you.
Thanks very much. Take care. Bye-bye.